Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
This show is brought to you by Miles Franklin. They've been selling gold and silver for 22 years, and I'm a customer because when you buy, they ship. For more information, go to milesfranklin.com or call them at 800-822-8080. 1490 WGCH. This is Carrie Lutz. You're listening to the Financial Survival Network. We're back with Danielle Park and our bi-weekly get-together on what's wrong with your bank and what's wrong with the world. Hey, Danielle, great to have you back on here.
Hey, thanks, Carrie.
So we're talking about banking and continuing the theme of too big to fail, of too sick to save. There's some real major causes of this, isn't there?
Yeah. And, 60 Minutes did a good piece. I put it on the blog this week, and they were looking at the financial crisis and causes, et cetera. And I thought it was good. The only thing that I thought was a big problem in that is something which I feel a lot of people today have backwards. That is to say, they said, the collapse of Lehman caused the financial crisis. And that is so improper to state it that way. Lehman was its collapse was a symptom of the credit crisis. But the cause of the credit crisis was the 20 years of reckless policies and bad behavior that led up to that bubble being formed in the first place in the world's property markets, in financial markets, the integration of the banking sector with the selling side, with the deposit taking side. And what's really remarkable is that we've already lived this exact story several times through history, but most recently in the early 20s. And, to say that the Great Depression, that the stock market crash caused the Great Depression is also incorrect. What caused the Great Depression was, the 20 years before that, when, we had things like the bringing in of paying down ways to get credit into consumers' hands. So, for example, they brought in the putting away on layaway. So people were able to buy things on time. That was a development in the early 1900s. They brought in the first mortgages in the real estate market in the early 1900s in the U.S. So people were able to start buying things on credit in a way that had not been available before. So you get this big run-up. And let's not forget the invention of the Federal Reserve. So you get that as well. And they then start to facilitate more consumption by how did they do it, Carrie? How do they always do it? They lowered interest rates and they allowed, they held them at artificial levels so that more consumption could go on. And that prompted this big run up in the housing bubble, peaks in 1925. Then everyone runs to Wall Street speculating because all the investment bankers are cross-selling everything under the sun. It bursts. And then all hell breaks loose in the aftermath, and everyone sort of says, why aren't governments fixing this? Well, the problem is that governments can't fix it. It's far too big for any government, whether it's Republican or Democrat, to fix. But what they could have done better would be to try and regulate the banking sector and keep certain ethical principles in place on the rule side. Since they didn't do that, then they created, they were party to the big bubble. And we saw that again in the last run-up. So it's sort of amazing to see this movie again.
Yeah, and, another thing that caused the Great Depression, we had financialization of the economy. We had options and futures. And one of the things that they abolished after the Great Depression hit was options on stocks. And there were very few things, agricultural commodities, you could have options and futures on. There were no futures on paper. It was strictly commodities. So we forgot about that as well. And then going back, Glass-Steagall gets passed, and it says you have to separate commercial repositories whose sole purpose was simply to store your money and make loans. And then the more glamorous part, or currently more glamorous, investment banking had to be split off. And that was a direct shot across J.P. Morgan's bow. at the time, there was a whole undertone of the regulation that was going on where it was the Rockefellers against the Morgans. And part of that was to take away J.P. Morgan's power. He was gone, but the House of Morgan lived on. And like you said, here we are. It's 80 years later, and we're exactly right back where we started from, except now all these banks are too big to fail.
Yeah. And you know what I find fascinating about that time was we went from a period of extremely low taxation rates, as an example, in the early 20s. That was part of this inequality that developed in society where the rich got richer on speculation in financial assets. Most of the population was left out of it, other than some consumer goods they were able to buy on time and credit. So you get this divide developing. It comes to a crescendo when even the rich get hit, because the asset bubbles finally break. And then you have, this period of suffering where everybody pays the price. So the rich people have to pay more tax because tax rates went to 25% at that point, and they had to build them back up again to try and start funding some of the deficits. The poor people had to suffer because a lot of the benefits or things that they had hoped to be entitled to were simply not affordable. And you see things like when they bring in Glass-Steagall and they raise tax rates, the rich folks like DuPont and JP Morgan actually went to try and do a military coup, Carrie, if you remember that story, right? To overthrow the government. And it was this General Butler they tried to pay, give him money and PR to do this. He went to Congress and turned them in, basically. Otherwise, they would have tried to orchestrate this overturn of the government. So you have a lot of themes, I think, that you see again today. But what's fascinating about it is, so they finally get this division of investment banking and deposit taking in Glass-Steagall, 1933. They also bring in the Trust and Securities Act at the same time. They also bring in the FDIC coverage, like everything they could think of to try and sort of re-regulate the banking system. Well, people will say, well, you can't do that. It won't work. Well, it actually did work. It worked for a long time. And then they started, the banking lobbyists started in 1960, basically, to try and chip away at that. And they kept it up, through really the whole lobbying culture, Carrie, kicked off in that period, right? Where it became a high roller business. People were really well paid to go after government officials. And then finally you get this, in 1986, there was that little crack where they said, we're going to let banks do 5% of the revenue in the investment banking side. That was the first little crack. And then, a couple of years after that, you get Chairman Greenspan come in, like the poster child for laissez-faire. And I know there's a lot of people that say, well, laissez-faire is the true capitalist model. But you can't have laissez-faire when you have a Federal Reserve intervening, constantly manipulating. That isn't laissez-faire. That's very much cherry picking of your idea of what free markets are supposed to be doing. So you have him come in as the poster child for deregulation, and the die is cast. By 1999, they'd finally executed Glass-Steagall entirely. And we were right back to business as usual. The incestuous mergers took off with a vengeance. And here we are. So I believe that we will actually go back to a division of those two levels. And I know lots of people today say, well, that could never happen. But it can happen, and I think it must happen. And the reason is because human behavior cannot handle unfettered self-interest like that. It just goes to explode the system, and then everybody pays.
Everybody pays. And these guys, like you said, the lobbying effort, everything, they own the government now. The big financial institutions own the government. Another thing that happened with the elimination of Glass-Steagall was full interstate banking. Prior to this, people don't remember, if you were in New York, you couldn't have a branch in California. You had to be just a New York-based bank. And then they said, well, we have to make bigger loans, and it's inefficient. But they were making bigger loans. They just syndicated. And all the banks had syndications, so the risk got spread out much better. But then, once they allowed interstate banking, that led to the total concentration of banking in 4 or 5 institutions. Those institutions were extremely powerful before, but then they became totally dominant, and they're the tail wagging the dog. Where one other thing was the Federal Reserve blew these bubbles in the 20. They blew two bubbles, real estate and stocks. And prior to that, in society, you'd have irrational exuberance. You would have speculative bubbles, but only one at a time. Like there was only one tulip boom in the Netherlands in the 1600s. There was only one South Sea bubble in England and one Louisiana land purchase boom in France. That was it. But here, with you've got unlimited liquidity compliments of the Fed, you have multiple bubbles, and multiple bubbles is really what sank the country in the 30s. First, stocks blew up, and then real estate blew up, and then we were in it for the long haul. And that's what happens here. Multiple bubbles. Here we're talking, we had real estate, financial instruments, and arguably U.S. Treasury and the dollar. Those are the bubbles that are left.
Absolutely. Well, and it actually, the first real estate bubble peaked in 1925, and that's what the precursor was to the risk-taking that then ran to Wall Street in 1929. But what I find amazing, too, is that Greenspan's main rhetoric for why he said that they had to allow deregulation in the banking sector was an argument of international competition. So kind of back to what you were saying there, back in the original structure of the early 1900s, they had a model where trust and commitment between two people had something to do with lending. So if you wanted a loan, I had to know you in my community as the manager of a bank. I had to look at what you did in your daily life and habits, figure out whether I thought you were a good credit risk, whether you'd pay it back, go look at your business and talk to some of your customers and decide, is this a good risk? Is it a good business opportunity for the bank? As soon as you start building that model out, so you are no longer directly accountable to the between the borrower and the lender, okay? When you keep commoditizing it, it's the same with financial services and management, frankly. If I'm sitting across the table from my clients and I know that I have the only $2 million or whatever amount of money that they have in the world, okay? My idea of risk management, looking them in the eye, ought to be, at least, considerably higher than if they're just somebody, a nameless plug in a pool, their money's in with a million other people. I don't know who the hell they are. I don't have to care. And you know what? Maybe they got lots of other money. I can fool myself with narrative fallacy that this isn't only just life savings. This is just a portion of a whatever. And that whole accountability breaks down. And why do we scale and why do we expand and why must it go bigger and bigger all the time? It's human greed and ego. That's really what it comes to. And you can say, no, it's about efficiency. It's about international competition. That's hogwash. We have less competition in financial services today precisely because of this. We have much less accountability. We have, 5 firms basically running the show. And they're so interconnected because they were so, incestuous that they are all one big cancer now. So I think we've allowed this experiment, this science project to run the full gambit of possibility on a larger scale this time than ever before in human history, Carrie. We've accomplished it. We know how this one went, right? Time to tabula rasa, admit that and say, okay, well, you know what? It's probably best if we're a little more modest, a little less scale, a little less profitability, a little more accountability, and just back that model up. And I think we will do it, and we'll probably do it finally in the next few years, because I think we're at the end of the line of credit, so to speak. Yeah. You're seeing that the meetings of the IMF, so they come up with another $400 billion. The political will, the support from the voters, it's all in the decline phase here. And the good news is this. They're saying, interest rates are moving higher in some of the, for example, Eurozone countries because they clearly have debt problems. Okay. People are saying that it's up to the Federal Reserve or the ECB or whatever to step in and stop this from happening. I say that's exactly the wrong call. Higher interest rates are there as a reflection of your credit quality and capacity to pay. Risk. And if you have higher interest rates, you have a big incentive to try and pay down your debt to reorganize and to become a better credit quality, right? If interest rates are constantly subsidized by whether it's a family member or a central banker, you don't have to actually adopt fiscal discipline at all. So we have done nothing over the last 4 years except extend and pretend bad behavior. So I think maybe now we're going to get to the time where that's obviously not going to continue to work. And now we'll push back on that. It'll go back to individual communities, families, communities, states, cities, everybody will have to work on getting their fiscal house in order with more efficiency. And that'll be a positive development.
Yeah, the trend, I was just talking with Charles Hugh Smith about this, localization. We're going from globalization to localization. In the good old days, in the 60s, when I grew up, the local bank, there were 3 or 4 of them, and if you were in a larger town, and like you said, they made character loans. They looked you in the eye, and they knew your reputation. Reputation meant something, and they would decide based on your character or lack of it whether or not you got the loan. And then the local bank is a thing of the past. Doesn't exist anymore. It's gone. And these too big to fails, forget it. They don't care about anything. They don't care about the community. It's all about the bottom line. It's all about bringing in fee income by charging you $35 if you bounce a check, by charging you for everything under the sun. And we've just gotten to this thing where they're totally parasitic, and they're really like reversed Midas touch. They're destroying everything that they touch. And at the same time, the Federal Reserve has made it near impossible if you want to open a bank. If you want to start a bank from scratch, it's almost impossible to get approved to do it unless you know somebody or you've got like $1 billion behind you. So therefore, the Fed is standing in the way of any possible healing. And like you said, until they step aside, interest rates go up, then people start saving again. There was no time in the U.S. history where the savings rate was greater than when Greenspan's predecessor, Volcker, raised rates to 20%. Everybody was trying to save money, put it in the bank because they were getting such a phenomenal return.
And by the way, Volcker was one of the few people who rejected the idea of eliminating Glass-Steagall, of that slippery slope when they started chipping away at it. When he was the head of the Federal Reserve, he voted against the motion. So he's one of the few people that has ever demonstrated some wisdom and leadership in this dynamic. So, but it's, as I just continue to see that there will be a movement away from the extractive mentality. Okay, so when I talk about extractive mentality, it's like if I'm giving a financial advice to someone who is managing a local business, for example, or anyone that needs financial advice, I would look at it and say, okay, you want to start a new business, here's what you need to do. You need to sacrifice yourself first. You need to probably use your savings, try and use as little as debt as possible to get going. Don't expect to take out a profit for the first several years. It's a long-term build. Go in low, do 10 jobs yourself, hire very little staff. That's the way people get businesses going. That's how they add value, right? So if you're running a business and you're the shareholders, you make certain decisions that are you sacrifice your own desires and needs first to get that entity off the ground, to make it healthy and to get it through business cycles. If you look to the new culture of extractive mentality, everything is about what do I get up front? Like the people that call themselves investors today in publicly traded companies are very often not investors at all, because they actually don't want to wait more than 6 minutes to get their feedback. When's it going up? I want my dividends. I want this. I want that. And I think that is a perfect marriage of disaster, because it runs most businesses either drives them to these ridiculous incentives and models that are all about scale, and nothing about building, nurturing, equity, wealth, stability, strong balance sheets, And so I think what we've seen is that reckless overlay, which came from disproportionate incentives in the financial sector and poor regulation and this interplay between government and bankers, frankly, now we're into a point where you're getting a rejection of that, and people are seeing that to build value there's no magic bullet. It's not, we'll teach you the trick. It's, here's the deal. You want to build value, you do it the old-fashioned way. And then, that would be really exciting because we'll actually get some wealth built in the economy again.
Yeah, well, that all goes back to how wealth gets created. It doesn't get created by the Federal Reserve. It doesn't get created by presidential edict. It gets created. And this was actually an issue in the Connecticut senatorial campaign where the guy who got elected, Blumenthal, I think his name was asked, how does a job get created? And he was a lifelong government worker. He didn't have a clue. And the woman who was running against him was the head of the World Wrestling Entertainment. But she actually understood how a job gets created because you need the person's services. You can turn a profit on it. And it's all about profit incentive. And when that person costs you too much, you don't have that person unless the government tells you you have to. And that should have been the end of the election right there, but he went on to win for some reason that still eludes me to this day. But wealth gets created through savings, through investment, and through being thrifty. And like you said, when you start a business, and I've done it before, and you sacrifice for the first couple of years, you don't take a salary, you don't go on vacations, you keep your debt and your household expenses to a complete minimum because you're building something, and the reason you're building it is you want to make money on it, and you'd like to pass something down to your children. You do a lot of what you do as an investor, as a business owner, because of your children, because you want to leave a legacy. And these low rates destroy all those incentives and actually have the effect of destroying wealth, not creating it.
Absolutely. And I would say, because I hear there's a lot of ego in business owners too sometimes, that certainly, well, let's not say too many small business owners, but a lot of these large, I'm going to talk about the Jamie Dimons and the, head of these multinational companies, they get to the point where they believe that they create jobs. And I would differ strongly with that. Customers actually create jobs. Customers. And you need customers to have some money in order to buy your products. Regardless, you can think you're a genius. You can extract, $100 million a year out and call it your, compensation structure. But at the end of the day, if you leave no value in the business to ride out the business cycle, you deplete its strength. And at the same time, you have no resiliency in the consumer because they've already been stripped bare. Like you've already enticed them to buy when they shouldn't have bought. They bought and bought and bought and bought. And now they've literally blown their brains out on credit. So now you have no customers. So that's, how do we build customers? We let them heal their balance sheet. We don't keep throwing them under the bus and driving over them again, trying to get all the incentives the government's rolled out, all the cash for clunkers, all the trying to force people to buy more houses and more clothes and more Coach bags is just totally nonsense. And yet, that's been the mainstay of the last few decades. So I understand why it's quite a shift for people to see, the turnaround. Here's another thing I was thinking about recently. I've over the years, people have sometimes shown me their financial scenario and said, "What do you think? Should I pay this off, or do you think I should declare bankruptcy, or will that hurt my credit too much?" And a couple of times I've looked at the scenario recently and thought to myself, you know what? If there's no chance that you can pay this off, perhaps it is better to get the consumer to declare bankruptcy. And I know morally lots of people have problems, but my point would be that there's been lots of moral, lots of moral hazard everywhere. Lots of people contributed to the fiasco we're in. So if a person goes bankrupt, wipes out debt, they won't be able to get credit for a while. You know what? that may be exactly the right thing. Because if they try and manage the debt and keep the credit going, the chances are they're going to end up in the hole again, right? Living with fiscal discipline, if forced fiscal discipline is when you literally can't get any more credit. So I think in some ways, people that are trying to do the admirable thing and their house is underwater and they can't see any consumption ability for years because they're so in the deep. This is like on a country level. I see this in Europe.
Exactly. Exactly.
I mean, at some point, you need those customers. So you got to, they need to tabula rasa, say, sorry, I borrowed too much. It's no chance I'm going to be able to pay this back. And I know you won't give me any more credit for a while. That'll be a gift. Actually, it'll be a gift because then I will just have to double down, figure out ways to be more efficient with my time and my income and learn to live without the debt. And if you can do that, I know we're going to be so much stronger in time than we are today.
Yeah. And along those lines, for a country to go bankrupt, meaning they default on their debt, they repudiate, which always happens. Every country has repudiated their debt at some time or another, with the exception of the U.S., but that's going to change. When the country repudiates the debt, they're shut out of the credit markets for 5 to 10 years, and they actually increase, local industry increases because they can't finance imports, so production goes up within the country, and their balance sheet improves because they can't resort to debt, which debt is a wonderful thing, except that you have to pay it back. And in the U.S. right now, we're in the position where we're paying interest on interest, which means you can never pay the debt back. We're not even thinking about how we're going to grow our way out of it. Can't be done. And on that note, hopefully we'll be able to grow our way out of a lot of things that are happening after the debt bubble is cured. You've got to have liquidation of debt to have a true recovery. So Danielle, jugglingdynamite.com, that's where we find you?
Yes, sir.
All right. And any questions, just send it to Danielle at that site or go to financialsurvivalnetwork.com, click the contact tab, send me an email, answer everything, leave comments on the site. And you can also go there and see, listen to Danielle and mine, our previous discussions on this topic, because these are the issues that need to be discussed. And of course, these are the issues that governments are avoiding like the plague, right?
Right now, yeah. They want to be reelected, but they're not being anyway. No one's getting reelected. Have you noticed?
Yeah, like we can only hope. Throw the bastards out of office, right? Like, how they ever got elected in the first place is a mystery, but keeping them in there is just a sheer act of insanity.
And yet we need someone to be in charge. We have to have some leadership. And we've got to have, I think it's like a parent is too easily blamed by kids that have no discipline. I think we're too easy to blame governments when we don't want to change behavior. I think all of us have to change this.
You're so right. And in my little town in Westchester County, we actually managed to get a guy in who's a fiscal conservative, and he's chopping the hell out of the budget. And you'd think the way these people are howling, he's expecting them to work for the first time ever. The way they're howling, you would think that he was trying to kill their kids. It's amazing.
Yeah. And yet he's trying to help their kids. And we need more of that strong leadership that's willing to sacrifice their own, perhaps, political term to do the right thing and to lead. And if we can get some people with some, chutzpah out there doing that, and we get some population that can't rely on credit. And that goes back to, listen, if governments can't get any more credit, they have a very good reason to turn to their voters and say, I'm sorry, but this is the money in the pot. We can't get more money, so we have to be really efficient with what we have. That is the answer.
Hey, you're spot on. And the guy who's running our town right now, he took a $50,000 cut, half his salary, and he's hiring a professional administrator who knows how to bid out contracts, knows how to pave the roads, knows how to handle the basic functions of government that this guy could do too, but he doesn't want to be in that role. He wants a professional COO running the town, even though it's a small town. And that's a model that hopefully will get copied over and over, because if we can't save ourselves on a local basis, there's no way we can save our counties, our states, provinces, and our countries and our world. It has to begin on the local level. That is the key. So anyway, we got to run, Danielle. See you in a couple of weeks. Be well.
Okay, thanks a lot. Nice
All right.
to speak to you. Bye.
Take care. Bye.